Meet John. For 10 years, he worked hard, lived below his means, and saved every extra dollar he could. Eventually, he reached a milestone most people only dream about: $1 million in cold hard cash. So, when he found his dream house, he did what looked like the smartest financial move possible. He wrote a check, no mortgage, no monthly payments, zero debt. The house was completely his, and John felt genuinely free. But here's what's interesting. Many wealthy investors would look at the exact same house, the exact same $1 million, and make a completely different decision. Not because John made a mistake, but because they see one thing most people never think about. What John bought wasn't just a house, it was a financial trade off. And once you see that trade off, you may never look at money the same way again. The exact day John bought that house, something interesting happened to his wealth. His money stopped working. Now, let's be perfectly clear, buying a home outright isn't bad. For millions of people, a debt-free home provides priceless emotional security, stability, and peace of mind. But on a pure financial spreadsheet, a massive portion of John's net worth is now tied up inside a single illiquid asset: the house. If an unexpected, once-in-a-lifetime business opportunity knocks on his door tomorrow, John can't easily access that money. If an emergency hits and he needs liquidity fast, selling a property can take months. Unlike stocks or index funds, you can't sell a house one room at a time to pay the bills. John is officially rich on paper, but cash poor in reality. Now let's go next door. Meet Mark. Mark wants the exact same house, same street, same view, same price tag. But when Mark looks at the house, a different thought crosses his mind. He thinks, if my money is already working for me, why would I pull it out if I don't have to? That's because most of Mark's wealth isn't sitting in cash. It's invested. Broad stock market index funds, businesses, commercial real estate, assets that he expects to keep producing returns over time. Historically, broad US stock market indexes have averaged roughly 10% annual returns over very long periods. But that's only a historical average. Some years are incredible, some years are painful, and nothing is guaranteed. Now, here's the key difference. Mark doesn't want to liquidate his investments to buy the house. Why? Because selling could create a significant tax bill, and it would pull money away from assets that may continue compounding. So instead of draining his wealth, Mark asks a different question. Instead of selling his investments, Mark walks into a bank and asks a simple question. If I already own valuable assets, can I borrow against them instead of selling them? For many wealthy investors, the answer is often yes. The bank reviews his investments, his income, his credit profile, and the overall risk. If everything checks out, the bank may offer a loan secured by those assets. Now Mark has access to cash without immediately selling his investments. In simple terms, Mark is trying to keep his investments growing while using borrowed money to fund his purchase. If his investments grow faster than the cost of borrowing, the strategy can work very well. But that's a big if, because this is where things can get dangerous. But this is the part most people focus on far too little. Leverage can accelerate wealth, but it can also magnify losses. Imagine the stock market drops by 25% or 30%. Suddenly, the assets backing Mark's loan are worth much less than before. In many asset-backed lending arrangements, the lender may require additional collateral if the value of those assets falls too far. In extreme situations, assets can even be sold to protect the lender, And that's exactly why borrowing against investments requires discipline, a lot of discipline. The most successful investors don't use leverage to gamble, they manage risk obsessively. They keep borrowing levels conservative. They maintain large safety margins because staying in the game during a market crash is often more important than maximizing returns during a bull market. At this point, you may be thinking, isn't this what people mean when they talk about buy, borrow, die? Exactly. Stripped of the internet hype, the concept is built on three core ideas. First, buy quality assets that have the potential to appreciate over long periods of time. Second, borrow conservatively against those assets when appropriate instead of immediately selling them. Third, pass those assets to future generations through proper estate planning, which can provide important tax advantages depending on the laws in place at the time. Now, the real world version of this strategy is far more complicated than social media makes it sound. It often involves financial advisors, tax professionals, estate planning attorneys, and a deep understanding of risk. But the mindset behind it is simple. The wealthy often focus less on spending capital and more on keeping their capital working. So, who made the better decision? The guy sleeping peacefully in a debt free home, or the guy keeping his money invested and letting the bank finance the purchase? The honest answer is it depends. For many people, owning a home outright provides peace of mind that no spreadsheet can measure. For others, maintaining liquidity and keeping their money invested may create greater long term opportunities. Neither path is universally right. The real power comes from understanding the trade offs. Because once you understand how money actually moves behind the scenes, you start making financial decisions very differently. If this breakdown changed the way you think about wealth, finance, and investing, subscribe for more deep dives into the strategies and psychology behind money. And let me know in the comments. Imagine someone hands you $1 million tomorrow morning. By tomorrow night, are you living mortgage free in your dream house like John? Or are you keeping your money invested and using the bank like Mark? I am genuinely curious where you stand.